Trump's tariffs. What will it mean for UK landlords and UK property investors? The S&P this week fell by 4.8%. The biggest drop, can you believe it, since COVID first swept through the industrialised world. It's almost certainly the harbinger of a contraction in business investment, in consumer spending, that will push the US close or into recession. So if you've done any reading on it, it would make you wonder why on earth it's gone ahead. Personally, I would say he's a negotiator, isn't he? He's gone in hard with the idea that hopefully people will back off and give him better deals. I can see that occurring. Capital economics are saying that US inflation will be above 4% by the end of the year, based on all the extra counter tariffs that will come into play. It's more bearish and it's more horrible than most bearish scenarios had ever suggested, which has prompted confusion as to what will happen to interest rates. In the US, higher inflation certainly and weaker growth will mean that it's possible the Fed will be very strong in cutting rates, because that's the way they do it. They work quickly and they go hard. UBS is now saying, according to Bloomberg, that they expect at least 1 basis point cut, 4 25.25% cuts this year. The market has so far taken that view, and the benchmark 10-year Treasury yield slid under 4% as traders priced in those cuts. But what about the UK? I mean, that's where our market is. We don't really do a lot in the US. Around the world certainly, but not in the US. Swap rates, which is basically what people think is going to happen to mortgage rates, have dropped, which could tee up a cut in mortgage rates in the weeks ahead. Gilt yields slid below 4% for the first time since the Great Trust experience. So it's looking like the market thinks that's what's going to happen. The Bank of England is expected, according to traders, to cut at least 2 lots of 25 basis points, so 0.5% of cuts this year. But to be honest, cheaper mortgages will be one of the very few, if the only, benefit of this, the only silver lining. Oxford economists are saying that GDP growth will drop to a little under 1% this year and cut its 2026 outlook to 1% as well. So that's pretty grim. And what that mean to Chancellor Reeves is that she's built in this £10 billion buffer based on things going well. She's already lost 17 billion from the last year. It looks like that 10 billion is not going to be enough either. So it's going to be pretty bad. Her headroom is going to be going, so there'll have to be more tax raises going forward. The Bank of England is a very cautious animal. They'll probably stick to their more conservative approach and try to cut as little as possible. But you look at what has happened in the past. COVID, things were cut to virtually zero. Is it going to be another trade war of that situation? Because there's so many different fundamentals coming to play. You have got the Ukraine war. You have got the lack of globalization stopping. You have got this trade war kicking off, which is more globalization to be halted. What could be the future? See what's happened to stocks and shares. The Dow Jones fell by 10% in February alone. So for a lot of investors, it's quite a tricky period. And what you're going to perhaps see in the UK is long-term inflation expectations have risen sharply. Central bankers will watch that and expect higher inflation will stop them from cutting rates. But higher inflation will make employees want more, and employees want more higher raises. Employers, therefore, may preemptively get into that, which is a self-fulfilling cycle that drives inflation up. A Bank of England survey of finance chiefs earlier this week showed expectations for consumer price growth have risen to 3.2%, the highest in a year, while firms plan to raise their own prices by 3.9%. So that's in their inflationary issues. What's actually happened though? What's behind all this? Well, the UK has been hit with a 10% tariff on all its goods being brought into the US, which Trump says is in retaliation for UK tariffs on American goods. I mean, compared to the EU at 20% and others up to 47%, the UK got off very lightly. And what does it mean? Jason Hollins, who's a fund manager at Evelyn Partners, quotes, "We can be very sure that this will be bad for the stumbling UK economy at a time when households are struggling with higher taxes and increased bills. But what we don't know yet is how either the government or the Bank of England will choose to respond." As I said earlier, I think it's a negotiating ploy, and I think Starmer will have to go back to him with some sort of appeasement policy to get it done. And it's probably already in the works. It was probably already agreed before it was announced that Starmer would do certain things, because I think that's the sort of shenanigans that goes on behind the scenes. The Bank of England will face a dilemma. On the one hand, tariffs are going to lift the prices of some goods. This is from Mr. Hollins. Bank of England will face a dilemma. On the one hand, the tariffs are going to lift the price of some goods, and its core remit is to keep limiting inflation. as close to 2% as possible, which could point to rates staying higher for longer than previously expected. Then on the other hand, the bank has taken a wider view of the economy in the last decade, also taking growth and jobs into account as part of this monetary policy, particularly when dangerous shocks occur such as this, as during the pandemic as well. It will want to support the economy from sinking into recession, which it will. It will go into recession. And it's quite possible that in regard price spikes related to the implementation of tariffs as one-off shock and focus more on economic stagnation, i.e. cut rates to get the economy going. He then goes on to say it's not unthinkable to actually see interest rates come down more rapidly than expected. Of course, any serious hit to the UK economic growth could be felt in the jobs market, not just in terms of job security, but also in terms of firms suffering uncertainty as to what their future is. As well as tax rises already in effect, it could restrict wage growth and salary growth. It would appear that, looking at the figures, that investors are increasing their bets on interest rate cuts by the major central banks in an effort to stave off potential global recession. On Friday, investors piled on more expectation of the rate cut by the Bank of England, driven by concerns of the damage to trade and economic growth caused by Trump's tariff decision. So that's what happened on Friday. People are expecting cuts in the UK. They're expecting at least 4 cuts in the US. Whether that comes to fruition, we don't know. But there is an economic problem that's going on. Richard Donnell, Executive Director of Zoopla, said the housing market is an extension of the UK economy, which sits within the global economy. He actually quoted saying the housing market has largely adjusted to the higher borrowing costs and slow economic growth. The impact of Trump's tariffs is complex to assess, but overall it's likely to suppress the UK economic growth and keep inflation at levels which will limit how much base rates will be cut in the near term. So that's quite negative. So you've got 2 parts to it. Traders and the market, which is normally right, saying we think there'll be cuts. On the other side of it, you've got people saying, well, they can't cut too much because it could lead to stagnation. If they cut too much, it'll lead to inflation. So it's a difficult balancing act. And that's really what they'll have to come up with and deal with. Traders think it's going to go down. Bank of England's trying to be cautious. It could go either way. What could happen? It looks awful a lot like, to me, is there's another economic shock. The Ukraine's situation isn't brought under control. Could be all like the start of a new COVID cycle, which is what some of the most talked about pundits out there are saying at the moment. It'll stop people from buying. The rich will get richer. Those people will now buy more houses and invest in more buy-to-let properties, and they will take more properties off the market for ordinary people to buy and live in, which will lead to more exacerbation of the UK cycle that we have at the moment. But it's not going to get any easier. So, Mr. Trump is a bit of a strange character. If you support him, jolly good. Good for you. I wouldn't mind him giving me a call and letting me know what's going on and why it is going on. What are the reasons? All we can do really is look at property as an asset class. Has it always worked? Over the long term, yes. If you buy in a sensible place using, as we say, PIE, population growth, infrastructure growth, employment growth. And in the UK, we still have good locations to buy and do that. So that's what I would stick to. So some questions and comments from this week. Raymond Darnold, bless him. The UK started to face these challenges when, economic challenges we're guessing talking about, Labour helped sell all of our exporting businesses and vehicle manufacturers, which they did. Mass uncontrolled immigration under Blair was started. I don't know if that's true or not. It's a free market economy working. That's the whole point about the Trump experience. He's trying to stop it being free market and come up with these negotiating stances to try and get a better deal for himself. But don't misconstrue it for what it isn't. It isn't good business, as the economy is showing in the US. It's actually a negotiating ploy. He did this last time. It didn't go as hard, but perhaps he's learned and he's got a harder way of doing it. Brum GP said, thank you for sharing the international perspective. Brum, my pleasure. Hopefully you get some benefit from it. Jimmy Fusion says, well done on 250. Always providing sound advice and information. My favourite property channel. Well, that's very decent of you. All I do really is just do a bit of reading and transfer on, hopefully, what I think is a balanced approach. But obviously I'm going to be a bit biased because I do believe, and I have had with my clients and myself, a lot of success over the last 30 years in helping people buy property and property derivatives. Most people are pretty happy with that sort of success rate. So if you get a chance, do like, subscribe, get a chance, download our ebook, which is bringing out a new version very shortly, the Expat Property Playbook, how to get into property around the world, other things. Again, the boys went up to Hong Kong 10s and we managed to get a loss in the final, which is great. Thank you for all our clients who went up there to support them. I hope they had a good time. Thank you very much. Do take care. All the best. Cheerio.